Thank you very, very much, John, for that. Well, I'm going to spend the next few minutes presenting evidence which strongly suggests that pulling the world out of recession and sustainably generating the Hicksian supermultiplier that John just talks about requires framing a vision of the benefits of government action. In the short run, as Andy just noted, the world faces a Keynesian paradox of thrift. This is what you get when there's a fear of a downturn, leads businesses to cut investment and shed labor, banks to retrench credit, and consumers to slow down on their spending. Of course, when everybody responds in this way, expectations become self-fulfilling in generating the very downturn that was feared. So the primary macroeconomic task before us at this point is to offset this and stimulate private spending, lending, and hiring in the short run. In the long run, the objective is to stimulate investment in complementary assets. In other words, to crowd in activity and indeed capacity. This includes investing not only in physical and produced capital, that is to say, locking into future-proof, productive and resilient infrastructure and not spending public money on propping up things like fossil fuel-intensive assets with limited productivity potential, but also investing in human capital to secure the skills and jobs necessary for the 21st century, as well as retooling and reskilling workers to enable those who have been affected by change to participate in the new economy, which fits in very well, of course, with the government's levelling up agenda. Most importantly, it also involves knowledge and intangible capital, as well as natural capital. Now, I'm going to say a little bit more about the importance of knowledge capital in a minute, but it's worth noting that within intangible capital, investment in social and institutional capital is required to deliver effective and functional government with popular support, rebuilding trust in the social contract, and therefore enabling productive activity. Andy Haldane estimates that the cash-starved social sector, which means things like charities and enterprises with social objectives, which are having a good crisis at the moment through the rise in neighborliness and volunteering, generated the equivalent of about 10% of GDP in recent years. So it's a key complementary asset that needs investment. It also means tackling inequalities, not just in income, but also in wealth and indeed in access to goods and services such as health and housing, transport, education, and even justice. And these are inequalities that, if anything, have been exacerbated by the lockdown following COVID-19. And all this, of course, requires additional support for the ONS to better measure the stock of broad assets. Sorry, can we have the next slide? I think I should have prompted those slides. I beg your pardon. That's the first slide on not panicking. The next slide. And that's the slide just now about expanding capacity. I slightly quick firing off the gun without prompting the slides. On to the next slide, which does catch us up. And just to note that against the framing that I've set up and that John has set out, sustainable, resilient and inclusive investment has some very appealing short and long run characteristics in a recession. In the short run, clean energy infrastructure, things like insulation retrofits, building wind turbines, broadband network investment, but also planting trees and restoring wetlands is very labor intensive, and it's not susceptible to offshoring or imports. So consequently, they impart quite high short run expenditure multipliers. In the long run, when we're talking about capacity, the economic multipliers are also high in these sectors. The operation and maintenance of more productive renewable technologies makes them less labor intensive, and energy cost savings are passed on to the wider economy. Next slide, please. Well, in the last recession, the main problem was a lack of shovel-ready climate investment. Well, this time around, the government's net zero program provides a number of investment-focused plans. The ones you see in this slide here are based on a recent letter to the Prime Minister from the chair of the Climate Change Committee. You can peruse these at your leisure later. In the interest of time, I'm going to move on. So next slide, please. Now, I said that I would focus on knowledge capital. Of course, the economy of the 21st century is going to be shaped primarily by knowledge and innovation. This is the key driver of total factor productivity, and it will determine our ability to get more out of the resources we have, resource efficiency, in other words, by directing the weightless economy to foster dematerialization and decarbonization. Now, the sheer scale of the low carbon transition means that network effects and economies of scale in production and discovery, as Nick mentioned already, are just so large that we invariably underpredict the scope for productivity augmenting clean innovation. So just within clean sectors themselves, we've seen an 80% decline over the last decade in key renewable costs, things like solar PV and battery storage. But there's also strong evidence to suggest significantly greater spillovers into other parts of the economy compared with more mature fossil fuel investments. Of course, the low carbon transition is one of many 21st century megatrends that we have to deal with, things like AI, automation, machine learning, and so on. But the inevitability of global decarbonization and the resource efficient shift is one of the closest things we have to a one-way bet. And this can help guide actions and help overcome strategic complementarity problems and inferior Nash equilibria. What do I mean by this? It means that effectively expectations are front and center. If you're a business or a mayor or a politician and you want to invest in green innovation, green investment, and you think no one else is going to, then of course you won't take the risk. However, if you believe that everybody else is going to deploy green technologies, then you will expect the technology costs to fall, the finance to go from niche to mainstream, the policies and supportive institutions to be established, and rapid market opportunities to evolve. So you will invest. And the very act of investing means that if everybody does the same, the expectations become a self-fulfilling prophecy. Once again, expectations, but this time in the long run, are center stage. Strong inertia and high switching costs often make it very difficult to shift innovation from dirty to clean technologies at first, but with credible policy intervention, once we reach a tipping point where expectations change rapidly, technologies can quickly switch from one network to another, as we've already seen. A second interesting feature of these network dynamics is that countries and companies that successfully invest in green capabilities early on have greater success in diversifying into future clean product markets. And then finally, a third feature of this investment is that because innovation is very path dependent and prone to tipping sets and reinforcing feedbacks, conventional economic models, as Nick already hinted, tend to systematically overstate the costs of decarbonization. So this means that rather than trying to fruitlessly predict the future, our efforts might be better spent trying to manage and steer that endogenous transition. Next slide, please. Well, the UK has lagged behind many other major economies in terms of investment and R&D over the last 25 years. I'm not going to dwell on this, again, in the interest of time. You know the story. We've highlighted this many times, for example, in our LSE Growth Commission reports. It's not a very reassuring picture, and it's one that we can certainly improve on and build upon. Next slide, please. Well, of course, there are opportunities from behavioral change. The reaction to the crisis has shown the possibility of rapid changes in the way of doing things. And this offers an opportunity to embed climate and productivity positive behaviors. These include things like strengthening connected technologies through high-speed broadband, improving residential energy efficiency to cut the cost of working from home, better use of urban space, increasing localization and self-sufficiency, reducing reliance on fragile supply lines, but noting importantly that independence is not the same as security. For essentials such as medical supplies or food or energy, global connectivity and collaboration enhances resilience. There's some unfavorable changes that we're seeing, anecdotal evidence from China, for example, of people shifting from public transport to cars. This testifies to the need to invest in public transport capacity to avoid urban sprawl and the hollowing out of cities. So to conclude, we've come full circle here. We started with behavior and confidence and we end with behavior and confidence. We've shown evidence that a coordinated strategy to restore confidence requires a credible vision to guide investor expectations. Studies like the New Climate Economy and studies we put out of the LSE have in the past outlined the opportunities associated with low carbon growth and resource efficient growth. These include non-trivial benefits such as tackling pollution, congestion in health and efficiency and so on. But the pandemic gives this vision a new and urgent dimension. So I'll leave you with a closing slide which suggests, if the next slide, suggests that a lot of people in positions of great influence outside the environmental sphere share the view that addressing these economic and societal and environmental challenges may be exactly the post-COVID medicine that we need. They suggest that the policies with the highest impact and the highest multipliers in many cases are the cleanest and most sustainable. So perhaps more people than we might think share Paul Romer's view that contingent rather than complacent optimism with early action to steer the economy holds the key to shaping future prosperity. And on that note of contingent optimism, I hand it over to Gus.